Howdy, Jacob here. Today we're looking at advanced micro devices in the semiconductor industry. Probably the second most popular semiconductor stock behind NVIDIA. $245 billion market cap on $241 billion enterprise value with 22.6 billion in revenue, up from 5.5 billion in 2014. So very substantial growth. You're probably looking at, I would think, about mid 20% CAGR there, and operating margin quite a bit up, gross margin up a lot, but their operating margin is very low. Return on invested capital is low due to their operating margin being low. Let's look at that. Is there just a lot of R&D going on? Oh yeah, huge R&D. Okay, so about 60% of their gross profit almost is going into research and development. So these could be some huge future payoffs for them. But again, right now it's going to minimize their margins a bit. But if let's say they even cut that in half, you're looking at about 2.5, 3 billion here. That's definitely 15% roughly operating margin. Balance sheet shows 3.9, 1.8, so about just under 6 billion in cash-like products, with 751 million short-term debt, 1.7 billion long-term debt. And the cash flow statement shows a good increase in capital expenditures. Again, that's good. They're using R&D to spend a lot, and they're also reinvesting back in themselves a lot. But their cash from operations are also quite a bit higher. Okay, their use of cash, share repurchases. Find that interesting. We'll see whether we think that they bought back those shares at a good price or not. And then otherwise, a little bit of acquisition, a little bit of reinvestment. So they're really reinvesting a lot back in themselves. We can see through their R&D going up. We can see that through their investment line. And then they're really just buying back shares. But their repurchasing of shares is not even offsetting their stock-based compensation, which is over 1.4 billion in total, the rolling 12. So although they are using good free cash flow to buy back shares, it's not even offsetting their stock-based compensation. So let's start making some assumptions here. We're looking at a tank of a company, 245 billion, and revenue growth side. I mean, they're investing like crazy. Last year was pretty bad, but I mean, with how much they're investing, I could easily see 15% growth. I mean, with that type of growth, 20 on the PE side. And then for margins, 10, 8. I think with how much they're investing currently, they could slow that down maybe close to year 4, 5, 6, 7. Maybe we'll let's do a pretty big range here. Let's maybe do like 8 to 12. Let's do 10 to 15 actually. So that's just because when I did this quick calculation over here and then just cutting the R&D in half, yeah, that would minimize their growth, but it would immediately hit their bottom line. And then over here, that would be able to push their cash from operations up a bit and then minimize that capital expenditures line from them reinvesting less. So I do think those are fairly reasonable. And then stock-based compensation, they're spending a lot to repurchase shares, but they're also issuing quite a bit of shares through stock-based compensation. So, I mean, I might just call it flat. And I mean, to be honest, I think that these are pretty frothy assumptions. I think I'm always skeptical of 15% revenue growth if it's already a big company. But again, you have to go with not their market size, but what is their revenue growth what's their revenue in comparison to the actual semiconductor market. And I know that from an AI perspective, semiconductors will be absolutely huge. So I think that's why currently these companies investing in AI, especially in the semiconductor realm, they just don't know how big that market can be. And I mean, again, I have no idea. 99, a bunch of people know, not 99% of people, but probably a bunch of people know more than me about the subject. And so, maybe they are right. But I think that to me, I'm a conservative value investor and everything is the present value of future cash flow. I think that the present value of their future cash flow to me seems pretty represented by these assumptions. And we get to a price that needs to fall 80% before we get the return I'm looking for here. And so to me, I think AMD, fantastic company. I think it's wonderful. But from a valuation standpoint, I just don't necessarily see I just don't necessarily see it working out because they're either investing a lot right now, which is going to hit their margins, or if they were to stop investing a lot, they could increase their margins but slow down the revenue growth. So I think that there's kind of, they'll probably hit a balance, I'm assuming, but I do think for now it's just a bit overpriced for me. So hope you enjoy the video. Have a great rest of your day. Thank you.